Hi everyone, this is Jathu, and today I'm excited to share a really important concept with you. And this concept is around the fact that all property markets return to their long term averages. So, how does this become so important? This concept helps me understand markets which are poised for good growth over the next 5 to 10 years and helps me separate them from the markets that might just have a few years of growth left. Okay, so just to give you some context, now we have several markets that are rising markets, markets that are recording positive growth. For example, Sydney, Gold Coast, Newcastle, Adelaide, Brisbane, Perth, they're all in positive territory. But how do you differentiate the ones that's going to have a slightly more extended period of growth and separate it from the ones which might just grow for 1 or 2 years and then stabilize? So, what I'm going to explain to you is just around this. So, it becomes really important. So, stay till the right at the end of the video because I'm going to show you how this can be used to identify markets that have a good run ahead of them. And that's the key to really identifying growth markets. Okay, so let's get into this. So, today I want to share some research that was done by Jeremy Shepherd, who is a leading property market analyst in Australia. And he was one of the very first few people who was using data to identify growth markets. Now, Jeremy's done a lot of research to identify the factors that actually contribute to capital growth, and he's also busted a lot of myths in this space. So, I want to talk about one of his most important piece of research that he has done to identify growth markets, and that's the relationship between past and future growth. Okay, so this ties in very much with what I was explaining earlier, that all property markets go back to their averages, right? So, what Jeremy is essentially saying is that a property market just can't keep on overperforming above its averages, or it just can't keep on underperforming as well, right? At some point, there will be some equilibrium that is reached and the market will change direction. To make it even more simpler, what that means is that if a property market has had above average capital growth in the past, then there are higher chances that it's going to perform poorly over the next 10, 15 years in the future. Conversely, if a market has underperformed in the past, then there are chances that it's going to perform really well in the future. So let's look at this research material that he has produced here. So he's looked at property markets all around Australia. He's looking at houses and areas which had at least 100K population and areas which had at least 24 sales per year. So the x-axis is showing the past growth per annum, so 15 years from 1990. So that's between 1990 and 2005. The y-axis is showing the future growth between 2005 to 2020, right? So as you can see that the red dotted line, which is the trajectory and which is what we really need to look at. And it shows that markets that have underperformed in the past around that 4.5, 2.5, 4.5, 6.5. The next 15 years, they've done really well and had 7 to 8, 7, 8, 9% per annum. That's where you can see the majority of the cluster. Each cluster actually represents a suburb here, right? And then you can see on the right side, the markets that have really done well, 12.5, 10.5% growth. You can see that they've only done 4% or 5% over the next 15 years, right? So you can clearly see a correlation between past growth and future growth. So the next slide, I want to show you exactly how it's being, what's happening in the Australian property market right now and how this concept can be used to interpret what's happening right now. Okay, So let's look at the most recent CoreLogic data, right? So if you look at this 12 months to June 2024, so this is the data between June 2023 and June 2024. Okay, it shows that the best performing markets in the capital cities are Perth, Adelaide, and Brisbane. Perth recording 23.8% growth, Adelaide recording 15.4, and Brisbane recording 15.8% growth over that 1 year, which is fairly very significant. And if you look at the regional markets, the outperformers are regional Western Australia, regional South Australia, and regional Queensland, which have recorded double digit growth over the last year, right? The One of the most poorest performers has been regional Victoria, which has recorded negative growth. So that's a minus 0.5 growth over that 1 year. So if we wanted to apply the theory that we just learned to these markets, right? This would mean that markets that are performing well now, so that's Perth, Adelaide, Brisbane, regional Western Australia, regional South Australia, regional Queensland, they should have performed poorly in the past, right? They must have performed poorly in the past for them to outperform now, or in the next 10 years. So if that theory is correct, then we should see a poor performance over the last 10 years. Similarly, for regional Victoria, since since we see that it's underperforming now, we should have seen a lot of growth in the last 10 years. So that's exactly what I did. I was looking at the last 10-year growth of these markets, and what you can see here, the first six is Perth, Adelaide, Brisbane, Bunbury, which is from regional Western Australia. I've taken Murray Bridge, which is from regional South Australia, and I've taken Townsville, which is from regional Queensland. And I'm looking at 2010 to 2020. How did their growth look like? So in Perth, you can see the last 10 years, 2010 to 2020, minus 11. So there was actually negative growth in Perth. Adelaide, 8%. So that's hardly any growth. Brisbane, 18%. Bunbury, negative 20%. Murraybridge, 4%. Townsville, minus 26%. Okay, so you can clearly see that these markets are underperformers. And what you see is that these markets are now significantly growing at a much faster rate, and that means that they're trying to come back to their long-term averages. They've underperformed in the past, and that's why they are kind of growing at a rapid rate now, because they need to come back to their long-term averages, right? And if you look at Ballarat, regional Victoria, 61% over the last 10 years. And that if you look at that past slide, Ballarat was one of the poorer performers. So again, that concept of mean reversion is clearly explained here. Now, what I shared with you is really important because it could help you identify where a market is in its growth cycle. Now, I hear a lot of people saying that Perth's done a lot of growth, it's going to slow down. Townsville just has had too much of growth already. Rockhampton's just had a lot of growth already, and these markets are going to slow down. But then, if you just go back to that past 10-year, past 12-year performance, you're seeing a clear underperformance in these markets, in Perth, in markets in regional Queensland, Townsville, Rockhampton, for example. They've had really poor growth over that 10-year period, and they are clearly underperformers, and which means that these markets have to go in some more to come back to their averages, right? And it doesn't mean that once it comes back to the averages, they're automatically going to correct or go down in value. It could also mean that they go to their averages and then they could exceed their averages and then correct themselves at a later point. So a very, very crucial piece of information. I think it's actually a game changer for you if you can really understand this concept of mean reversion, or the law of where everything comes back to its averages. Then you've really understood how the property market moves, and then this can help you understand and really identify growth markets. Now, I hope you found this content useful. If you like this video, please subscribe to it, and Please like the video so that I can make similar content like this in the future. If you're looking to buy a high performance investment property with a lot of capital growth, a lot of and a really healthy cash flow, then please get in touch with me and I'll sort this out for you. That's all from me today. I'll see you soon.